All right. Hey, what's going on, guys? It's Jack. Back again to talk about a bit of a different topic, but still within the realm of what we know, Activision Blizzard. But today I wanted to start talking about it more of an investor point of view. I graduated with a finance degree in college and then never really used it that much, so I figured since that was something I always enjoyed and never really used that much, let's try to make a little bit of a financial video, talk about where the company is at the moment, and what has been driving a lot of the price action for the company, and some of my positions and some of the action that I'm taking as my own investor into the company. All right. First and foremost, don't make any plays or any moves or any financial decisions and everything based on this video. It's just for fun, for education. Do your own research before you invest. You know the stuff. All right. So, since February of this year, Activision has lost almost half of its share price here, going up from 103 now into the 60s there, which has been pretty tremendous downturn for the company since they've been bouncing back ever since Morhaime left the company back in 2018. We can see back at the later part of 2018, Morhaime left the company, leading to a downturn, followed by a poor earnings report, and of course, lest we forget the Don't You Guys Have Phones BlizzCon, where the share price continued to fall even further. It stayed down into this range from the end of 2018 well into 2019 before it began to recover. And one of the biggest things that investors are looking at is not so much the monthly active users, but they're looking at the expectations of future growth for the company. And that is what's going to drive share price growth and development, all right? Because a lot of big investors are not super gamers like us. And we will also go over some of the biggest holders of Activision Blizzard, which can also be influencing the decisions that they're making, right? It's like we talked about. Expectations of future growth drive share price. Now, let's also start talking about the lawsuit, all right? Back in July 20th of this year is when the lawsuit hit Blizzard. But you'll notice that the share price didn't really react quickly. Now, in fact, it was still at around the 90s. So keep in mind, we're at the high 66 right now. It was still in the 90s when the news of the first lawsuit by California hit the company. And it actually stayed there for a couple of days. Now, notably, that Monday is when the share price began to collapse, right? Going from 90 to 84 and even further down into the high 70s, okay? The actual driver of this share price reduction began with the walkout, the Activision Blizzard walkout. Once employees got together over the latter part of that week and into the weekend and decided to organize a walkout, that is actually what led to share price collapsing. Employees not working, they're not making future games, they're calling for improvements to the company, which could add a lot of uncertainty. Does the company resign to their wishes and pay them more? Do they make changes in the office that are going to be more expensive? Is there more time taken away to talk to employees during business hours that they're not working? All of these things can lead to game delays. All of these things can lead to share price reduction, profit margins being reduced, and all of that. And keep in mind, in this video, we're not going to talk about, oh, is this morally right? Is this wrong? Is whatever. This is, we're talking about what's driving share price, what's driving the money, all right? Regardless of how we personally feel about this. So, with that, company began quite a downturn, which lasted a number of weeks before the share price began to recover. And then more news starts happening. There's federal lawsuit that comes out. There's securities fraud lawsuit as well, I think that's being litigated, which basically involves, hey, you didn't tell the shareholders about this and you knew in advance. That, of course, is going to get litigated and everything like that. But now, we've gone from an entirely different level. Because, I mean, let's zoom out on the chart once again. Up to that $100 a share in February. Now we're down to 60s, okay? And this was led by the most recent earnings report. And in this earnings report, some of the notable info is monthly active users flat. Wowhead and a bunch of other news reports and everything that are in the sort of Blizzard World of Warcraft scene always talk about monthly active users because we don't really have sub numbers anymore. But keep in mind, this goes back to 2018, end of 2018, and it's remained mostly flat since that point. Monthly active users, this is about the same area, right? monthly active users don't really care that much. Or sorry, investors don't really care as much about monthly active users compared to the big old money that they're going to be bringing in, all right? And if you take a look at this, yeah, it's remained kind of flat. But when you start looking at the company from their revenue and their cash flow that they're bringing in, revenue since 2016 been on the rise. Operating income, which is particularly important because you have to factor in the expenses in making this company, been on the rise. Net income, been on the rise. Constantly. Despite having a mostly flat level of monthly active users, the company has continued to grow its revenue. It has continued to be more efficient and be able to generate revenue and reduce their overhead in quite a substantial way. TD Ameritrade, of course, has a lot of their stock analysis on their profit margins. Their profit margin, of course, gross profit for the trailing 12 months, that's TTM right there for you, is about in line with EA at around 72%. We're able to see gross profit margin for EA versus the industry, 72%. Again, beating a lot of other competitors there. So being able to have a much greater level of efficiency for that company is hugely important. One of the other interesting things that you may not know about is there's also a nice measure of effectiveness for the company, including revenue per employee. So the trailing 12-month total sales divided by the number of employees at the end of the reported fiscal year. It's about $1 million per employee, which I don't know if you guys knew, but that's a crazy amount of money. And again, that's not profit, that's revenue, okay? That's just money coming in. There is going to be a lot of money that goes off to overhead, and that's why we were looking previously at the profitability, all right? Because profitability is taking into account all those expenses and everything. But still, about $1 million in revenue per employee. They're looking at that effectiveness for the company, all right? So they're looking at, in particular, the company's the best at managing their owner's equity and at managing their resources, and is above average at generating resources from employees compared to other companies in the entertainment industry. Well, where are we familiar with that? Blizzard layoffs, right? Blizzard layoffs. We've heard, of course, stories of employees trying to get hired back to the company only to get offered a lower rate, and cost decreases across the board, right? We've heard stories and everything like that as well about cost cutting. And this is here as an example, how to make that company more profitable and cutting costs and cutting that overhead, right? As a result, though, the company is extraordinarily liquid, all right? Their financial strength is absolutely fantastic, okay? We even see some of the analysis from, I believe it's the Street, and their quantitative analysis ratings and everything like that. And while their gross profit margin has decreased when compared to the same period a year ago, they have grown their sales and their net income, and Activision is extremely liquid. All right. Their quick ratio, which clearly shows the ability, is 5.1, which clearly shows any ability to cover any short-term cash needs. They managed to increase their liquidity, cash money, and short-term securities, despite already having very strong liquidity to begin with. This would indicate improved cash flow. All right. This just means, again, more and more revenue going to be being brought in, and a lot of times they're not going to be spending it unless they're able to fund very reliable future growth, right? Having that cash on hand is excellent in case they have to worry about a lot of debts. And as you can see right here, their total debt for quarter three was about $3 billion. It's in the millions, of course, so it's $3.6 billion in debt. But a lot of that debt is actually fixed rate. So just like your car, you might have a car loan and it might be around 1%, something like that interest rate. Whereas a credit card is going to be like 20%. But what's notable in the financial reports is that Activision said, hey, most if not all of our total debt is actually at a fixed rate. So we're not worried about using any of our cash equivalents to go pay off this debt immediately. But a quick ratio shows, can they do that if they have to? And they can do it very, very easily, right? But you might ask, well, why not take all this cash that they have on hand and start paying their employees more? Just, be nice guys and keep them around and retention. And honestly, the brutal answer is, why do that when it'll reduce the earnings per share, right? The company is constantly being looked at for the earnings per share, their earnings growth, and it goes into these quantitative ratings that the Street, Cifra, Ford are all going to be putting into it. This one in particular, I believe, is starting to show some of the earnings per share growth over time. Actually, it is this one right here. So Ford Equity Research is also talking about the trailing 12-month operating earnings per share and how it's trending positively and how it's constantly trending positively. When they start talking about the expectations from their investors and everything like that, they're showing net bookings of $1.89 billion, so a 7% increase year over year. Slightly beating their consensus by $1 million. Not a huge beat, but a beat nonetheless. Earnings per share, again, beating their estimates by a couple cents and everything like that. And the main issue, though, is while their current status is looking strong, their financial strength is really strong, they also are having to deal with backlash in their company from the lawsuit, from the uncertainty that those things bring, right? You might say, well, they have a ton of cash on hand if they have to pay out millions of dollars to California, but they don't, but the investors and the company itself don't know how much they have to pay out. And that's where the problem lies. When there are delays to game titles, right? When there is reduced guidance, when they say we don't expect, Diablo 4 and Overwatch 2 to contribute to our 2022 earnings, that immediately starts sending the share price into a spiral, because what they call priced in, they had priced in expectations that those games would be released and would continue to provide growth to 2022. Hearing that they're not then shakes up investors' expectations, and they don't like the uncertainty at that point. So that has resulted in the share price collapsing to where it is now, as they lost almost 15% after their earnings were posted. So huge loss there, but keep in mind, share price losses are not going to be forever. As we mentioned before, there are some excellent financial strengths to the company where they're able to hold on for quite a while. They have a market cap of $53 billion, and all of these investment reports have been updating their ratings for the company, with many of them maintaining buy ratings across the board. And again, this is not just Blizzard. This is not just World of Warcraft. This is the entire company as a whole. And don't believe me, start looking what we're saying. On November 3rd, our analyst here on the side of Cifra did update his analysis, John Freeman, and he said, we keep our 101 price targets. They're saying it's a buy. We're going to list it as a strong buy on a recommendation, and keeping a $101 price target based off a solid third quarter, in line with expectations. Very attractive valuation in our view, with shares down 15% post-earnings, and a PE, which is a price-to-earnings ratio. That's how much the share price is relative to how much money they're earning, below 19 times. So a lot of companies, we could take a look as well over here, are going to look at their evaluation for their price to earnings. And a lot of companies in the industry are going to be trading much higher than where we do see Activision. We can look, for example, at EA, and they're trading at a price to earnings of 51, right? There's also the PEG ratio, the price to earnings growth, where it's almost 2 on the side of EA. And they were able to see on the side of 1.5 on the side of Activision. This is the price earnings growth, okay? And I think they have the official definition. It's a stock's potential value since it accounts for the company's PE and predicted growth rate. So it's calculated by dividing all this stuff. A lower ratio indicates a cheaper stock price relative to projected earnings. So they say, hey, this stock price relative to how much we think it's going to grow in the future is actually very attractively evaluated. And the street has also had their valuation and everything like that they had previously. Here we go. So labeling it as a massive discount. All right, trading at a significant discount to its peers. Now, there's a lot of different ratios that you're going to be able to look at, right? Right here, it's showing that relative to many other peers for the price to earnings growth, that it's about on par. But there is going to be some expectations of lowered earnings growth from what we've seen so far. And companies cannot predict the future, right? They're never going to know how many people are going to be buying their video games. They're never going to know with 100% certainty whether this Call of Duty or that Call of Duty is going to be able to make tons and tons of money. But they do have some expectations that they're going to be able to go with. And like we saw previously, they are just about beating a number of their estimates, right? Usually what they want to do is you want to be able to set up expectations that you could steadily beat, every single time. Because if you have a steady beat, the share price can, of course, appreciate, but you never want to miss for a lot of these companies, especially not for one that is Activision Blizzard in particular, because Activision Blizzard does not want to have any sort of misses whatsoever as a Fortune 500 company, as an S&P 500 company, a very, very large corporation that has some extremely, extremely large companies invested into them. Most notably, you have a couple of companies like BlackRock and Vanguard who own both 8% and 7.5% of the company, respectively. They are the largest shareholders of this company. And keep in mind, about 90% of the available float, that's the shares in circulation, are held by institutions, right? They're held by State Street. They're held by hedge funds. They're held by, Morgan Stanley, Invesco. You can check it all out right here. These are very, very large companies with billions, if not trillions of dollars under management. And they all vote, right? And they all vote to be able to direct the company in the way that they want to. These holders of shares are the ones who are setting policy by voting in the board of directors. So they have enormous, enormous amounts of control. And if they don't meet the expectations of these companies, they're going to get voted out of their jobs, right? So always keep that in mind, the incentives for doing so. Okay, so with that, the expectation for a lot of these companies is, hey, it's at an attractive valuation at this point. There's still going to be elevated global engagement despite lockdowns ending. New games are going to be performance optimized for next-gen consoles, now shipping for a year, partially offset by a multi-quarter delay for Overwatch 2 and Diablo. But there is backlash risk due to a culture of pervasive sexual harassment from consumers, employees, and an increasingly socially conscious developer community, albeit likely limited to certain studios. Okay? So what they're saying is, yes, you, person watching this video, might not actually buy the next WoW expansion, might not actually buy the next game because of what's happening at Blizzard and Activision as a whole. They're also saying that the backlash could also lead to them not hiring as many developers or hiring as many talented developers because they're going to choose a different studio based off the backlash that's been received from this. So keep in mind, that can also start hurting their future growth when they're not going to have the talented developers coming into their studio specifically. But they say, hey, we think it's limited to certain studios overall. They say, all right, this is a problem, this is a risk, but because the valuation is stronger, because the company has saw its way through other delays in the past, that they're going to be tolerating it. And a lot of these companies that have been holding like millions and actually I should say billions, $6 billion worth of Activision stock, they're going to keep holding it, right? They're going to keep holding it. They're going to keep voting, and they're going to keep on having an impact on how the company is going to be run, right? Whew. So with that said, personally, my absolute bet, not based off of my personal feelings on the company or anything like that, but just the personal moves I make because money, is I actually bought the dip. I actually ended up buying what they call calls on the company for January that I think it's going to be above $70 at that point. So I bought a couple of January 22 calls at $239, and we'll see what pans out. If the share price rises above that level, I can make a bunch of money. If it doesn't and it stays flatline, much like we saw the company stay very, very flat after, of course, its disastrous BlizzCon back in 2018, and after Morheim leaving, then I could lose it. So we'll see. If you guys have any interest in this video or anything like that, let me know down in the comments down below. But my move basically is just built off the back of momentum. I went into it seeing how beaten up the company's stock price is, and I knew that a lot of different investors, in particular, a lot of different traders would be looking at the strong earnings growth. They'd also be looking at the stock getting beat down by 15% in the last 12 months. And they said this historical performance should lead to above average price performance in the next 1 to 3 months. And I said, hey, I'm going to be making a move based off of some of the research that I did. Again, always do your own research. Always, 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 because you can lose a lot of money in the stock market, and it is not great, okay? Don't do it. So let me know if you guys like this video. If you have any other questions or anything like that, comments down below. But personally for me, my move is I bought the dip. and I'll probably add more shares and everything like that as well to my position beyond just options, because options, of course, can expire and they decay over time. But shares you can just keep on holding for an extremely long period of time until they turn a profit. Personally, I bought like one share 2 or 3 years ago after that disastrous BlizzCon, and I held it for an extremely long time, and it appreciated. But keep in mind, all stocks, investing, and everything like that have tons of risks, so make sure you do your own research, all that other good stuff, all right? Thanks so much for tuning in, guys. If you have any other questions or anything like that, sure to leave them down in the comments below. But my pro-analysis or whatever is that I think that the company is going to survive this lawsuit. They're going to survive a lot of the backlash that's going to be happening around them. I agree with a lot of the stock analysts who are saying this is the dip to buy, and that's the decision that I'm personally going to make for myself. Unfortunately, Blizzard isn't the only thing driving ATVI stock price. Call of Duty, King are massive revenue generators for the entirety of the company. And if company's not going to be meeting up with the expectations for revenue from a certain studio, then ATVI is able to go in there, Activision can go in there and put pressure on reducing overhead, reducing costs in and out, to be able to make sure they're sitting at the ratio of overhead, the costs and everything like that they want them to be at. It's happened before, and it's going to continue to happen. And unfortunately, the gaming industry can absolutely be extremely brutal. Some of the things that could definitely lead to much, much more dire price action and continued losses on the side of ATVI is if there's any truth to the unionization of employees. That would absolutely send the stock price continuing to tank, and there's some significant risks if something like that were to happen. Also, if there's other walkouts, if there's continued delay for any other games, if there's other high-profile names who are leaving the company, there's a ton of different risks out there. So make sure you do your own research and make sure, you're using your money very wisely. Thanks so much for tuning in, guys. Hope you all enjoyed it. I'll catch you all next time.